Right. Hello, everyone. Welcome to BT 12503 Business Finance. This is Topic 1, Introduction to Finance, Part 2, Types of Business Organizations. So in this part, we are going to talk about identifying the key differences among the three major legal forms of business. Well, basically in business, there are three types of business organization, as we can see from the structure here. The first kind of business form is sole proprietorship. Second is what we call partnership. And the third one is corporation. Let's go with the first one, sole proprietorship. What is sole proprietorship? Well, it is basically a business which is owned by a single individual who is entitled to all of the firm's profit and is also responsible for all the firm's debt. Sole proprietorship owners typically raise money by investing their own funds and also by borrowing from a bank. So again, basically, sole proprietorship business is the business involve a single owner. For example, if you have savings, let's say worth around $100,000, and you wish to open your own grocery store. So in terms of the owner here is you as the sole owner, whereby you are the one who built the business using your own money. So that is an example of sole proprietorship business. Now, given that you are the single owner, it's a single owner business, you are the owner and you invest your money to build the business. Therefore, whatever debts or expenses or liabilities that your business encountered will be solely under your own responsibility. In other words, you as the single owner, you have the liability for all of the company's expenses. Now, the advantages of a sole proprietorship business is that it is relatively easy to form, right? Because it's based on your decisions whether you want to form the business or not. But of course, it requires registration. But if you compare with other types of businesses, sole proprietorship business is quite easy to form, whereby, and also you don't have to consult with others, while making decisions. It is 100% up to your own decisions whether you want to open your own business or not, right? But of course, if you would require some other opinions from other members, you might do so as well, right? In terms of profits, sole proprietorship business, the profits are taxed at the owner's tax rate, right? So you will be taxed based on your tax rate as an individual, right? However, the disadvantages of a sole proprietorship business is that you are personally liable for the business debt. So let's say if you open a business and you would require 50% of debt to form the business, so you are liable to pay the debt of that business. And the business cease on the death of the proprietor, meaning to say, if the owner is dead, then the business is going to close or ceased, all right? And also, sole proprietorship business has very limited access to external sources of financing because you are basically on your own, right? And you build your own record when you do the business. If you form the business on your own and the business is growing and is very successful, therefore, if you want to expand the business, there's a high chances for you to get money in terms of borrowing from the banks. But if the company is not doing well and you wish to expand the business, probably it's going to be difficult to get funding or financing. So it all depends on how you manage and perform, how you manage the company. Secondly, partnership. Now, for partnership, there are two types of partnership. First is general partnership. Second is limited partnership. Now, a general partnership is an association of two or more persons who come together as co-owners for the purpose of operating a business for profits. Unlike sole proprietorship business, general partnership has more than one owner. So it could be 2 or 3, 4 or 5. So as long as you have more than one owner, the business is called a general partnership business, right? So if you are the sole owner, let's say you own 60% of the firm, and you have your friend who invests 20% of their money in your business, so that friend, that partner is what we call the co-owners. So meaning to say both of you, found and co-found the business. So what's the good thing about general partnership? Similar to sole proprietorship business, it is quite easy to start. And still, in terms of taxes, you are taxed at the personal tax rate. But what's interesting is that in terms of access to funds, it's quite easy to get funds because you have a partner, as opposed to sole proprietorship whereby you are on your own. So if you are lack of fund, you have to probably borrow from other external parties like the banks. But in general partnership, if you are lack of funding, probably you can get from other partners to invest their money in your company. So in terms of access to funding, it is much easier as opposed to sole proprietorship. However, the disadvantages of partnership is that the partners, they jointly share unlimited liability. Regardless of how many % of shares they owned, whatever expenses, liability that the company have to deal with are being shared by the partners. Okay, contohnya macam kalau ada hutang, kalau syarikat tu ada hutang, so both partners share the same amount of liability. Sama-sama tanggunglah hutang itu maksudnya. Alright. And if the company is making profits, okay, they also share unlimited profits as well. It is not always easy to transfer ownership in general partnership. All right. If the person wants to remain in the company, you can't force them to transfer the ownership to other person. It's not always easy to transfer ownership. That is the disadvantages of a partnership, right? In limited partnership, is when the limited partners is liable only up to the amount the limited partner invested. Normally for limited partnership ini, okay, you are more of like being a silent partner. Your role as somebody who invests the money in the company, and you don't involve much in making the company's decision or in managing the company, right? This is what we call a silent partner, limited partnership. They provide capital, but they don't actually actively involve in making decisions, and they are not responsible for any debts beyond their initial investments, right? However, in terms of transfer of ownership, the limited partner share can be transferred to another owner without the need to dissolve the partnership. So you can transfer anytime you want. If you no longer want to stay with the company, you can just simply transfer your ownership to other person. And that is limited partnership, all right? Compared with general partnership in terms of liability, partners, they jointly share unlimited liability. However, in limited partnership, the limited partner is only liable up to the amount of the limited partner invested. All right. So for example, if you invest only 20% in the company, you are considered as minority shareholders, minority partner. Therefore, whatever liability occurs, you are only tied up to 20% of your investments only. All right. If the company have a huge debts, all right, you are not fully liable to pay to deal with those debts, right? Because your role is very limited. So that's the difference between limited and general partnership, all right? In other words, we can say that general partnership are those partners who are very actively involved in managing the business, while limited partnership is somebody who is not really actively involved. Their role is more on providing capitals, and that's it. They don't involve much in navigating the business. So that is partnership. Now the third one is cooperation. Cooperation is big, is huge, whereby a corporation is a, let me draw something, is a huge building like this. Okay, this is an example of a corporation. Okay, whereby in a corporation you have a lot of people act as the owner of the firm. Anybody can own the firm, all right? Or own means being the shareholders, all right? If you own the company, okay, you are basically considered the owners of the firm, okay? Therefore, if a very large amount of money are needed to build a business, then the typical organization form chosen is the corporation, right? I'll give you one simple example. You want to open a business, all right? As I mentioned earlier, for somebody to open a business, they need capital, right? It's either they can use their own money using retained earnings, or they can go for debt financing, berhutang, or they can go with equity financing, right? So first, they can go with retained earnings. Second, they can go with debt financing. Third, they can go with equity financing. Okay. So if to set up the business requires millions of dollars, therefore, you would need a huge amount of money to set the business. Obviously, you don't have the millions, right? So it's going to involve a lot of stakeholders, a lot of people. Probably you need to borrow money from the bank through debts, right? So several banks are going to involve in giving you loans to your business. While the remaining of the funds that you need probably might come from equity financing in the form of shares, saham. This is where you will get people to invest their money in your firm, right? You can get anybody to invest in your company, right? You can get your friends, your family. So anyone to invest their money in your company. When they invest their money in your company, they are actually the owners of the companies, part of the owners of the company. They are called as shareholders. Why? Because they have shares invested in the company. Right? So corporation is legally owned by its current set of stockholders. Bear in mind, shareholders and stockholders are the same. Right? This is an important point here. Corporation is legally owned by a set of stockholders or owners. So if you invest in any corporations, you are actually legally owning the company from the shares that you own. Now, when you have a big company like corporations here, obviously you are going to you need to have a group of members to manage the company. It's what we call the board of directors. So the board of directors is a top management who is going to decide the company's vision and mission and objectives. Right? They are the think tanker of the company, setting the hala tuju of the company. And the one who is going to run the company in terms of operation, right, are the management team. That's why you have the CEO, Chief Executive Officer, the company Chief Financial Officer, Chief Marketing Officer, and so on. Those are the company's management team. Now, who elects the board of directors? The shareholders. If you own the company, then you will be entitled to call up for a meeting to elect who will sit as the board of directors. So that's the beauty of being a shareholder, whereby you have the power to vote for those who is going to direct the company. And once the board of directors have been appointed, this board of directors will appoint the senior management of the firm. The senior management of the firm ini are those people who is going to run the company, to manage the company. All right. So who actually appoints the senior management of the team? The board of directors. Who appoints the board of directors? The shareholders. Who are the shareholders? It could be you. It could be anyone. If you have money, then you can invest in any corporations, right? And be part of the corporation. So the advantages of a corporation is that liability of owners is limited to invested funds. Let's say, for example, if you invest 10% or equivalent to $500,000 of your money, if the company is not making good profits and the company suffered loss, the loss that you have to bear is based on the amount of money that you have invested. That is all. Itu maksudnya limited to the amount that you have invested. But if the company is making huge profit, then you are definitely entitled for a good return in terms of dividend. And the dividend will be paid based on the amount of money invested in the company. Secondly, the life of corporation is not tied to the status of the investors. Remember, in a corporations, anybody could be the owner. Anybody could be the owner. Okay, there are a lot of people invest in a corporation. And the life of corporation is not tied to the status of the investor. Meaning to say, if, let's say, this investor died, right? The business will not cease. The corporation will not close or bankrupt. Even the second investor died also or passed away, the business will not cease. Okay? The life of the corporation will not end. Right? Probably the shares owned by this investor, who is already passed away, probably will be transferred to another new owner, probably among the family members and so on. So the ownership of the company will always be transferred to another party or another person. The life of corporation probably will be affected based on the company performance. If the company performs really bad and cannot deal with any financial shocks, let's say, for example, economic problems, and company can barely survive, which hugely affect the profit level of the firm, then it may affect the whole performance of the company, and in the end, the company might eventually cease in operation ataupun falls into bankruptcy. Like what happened to certain corporations during the COVID-19 pandemic. The situation was so bad, which forces some of the big corporations in Malaysia and some in the US to cease into operation. They have to close down the operation because they couldn't survive. Right? But it is not tied to the status of the investors. Another advantage of corporation is it is very easy to raise capital. Let's say, for example, next year, the company have new plan to expand their business overseas, and they require another extra $20 million. They can easily raise the capital from anybody who interested to invest. The company can open the shares, additional shares. Let's say they open additional 20% of shares to anybody who is interested or willing to invest. So here, when they issue new shares, it will be guided and assisted by an investment banker. Investment banks will be appointed and assist the company to issue new shares to the public. So they will find a new investor to invest in this company. So this 20% equivalent to, let's say, another additional $10 million. Right? So it's very easy to raise capital, either from equity financing, or they can also borrow from debts. It's very easy. However, the disadvantages of corporation is that they have to deal with greater regulations. It's not as easy as it looks like, because corporations involve a lot of people, a lot of stakeholders. Okay, you have shareholders, you have the banks, the auditors, the suppliers. You have so many stakeholders, which involve a lot of regulations, rules and regulations that you have to follow. And another disadvantage is that you will be double taxed. There's a double taxation of dividend. So first, you will be taxed on the profits that you get. Second, in a corporation, you will be taxed based on the dividends that you get. So it's a double taxation in the corporations. So that's the disadvantages of a corporation. Right? So these are some of the examples of corporations worldwide. I'm sure some of you have heard some of these companies like Amazon, right? HSBC, banks, Facebook, obviously, everybody knows Facebook. What else? IKEA from Sweden, and many others. So these are examples of corporations worldwide. Another examples of corporations in Malaysia are Genting Group, we have Public Bank, DG, Maybank, CIMB, Petronas, TNB, and so on. So these are examples of a corporation in Malaysia. So basically, a corporation involves a lot of people with a lot of money as well. So it's easier to get capital because of so many people involved, but we have to deal with greater regulations. So in a corporation, this is how the finance area fits into a corporation. As I mentioned earlier, the top ones, you have the board of directors. The board of directors are the one who set the direction of the company in terms of mission, vision, philosophy of the company, and so on. So they set the direction. And who elects the board of directors? The shareholders. Right? Now you have board of directors. So this board, they need a group of people, a team to manage and run the company. So they are going to appoint this group of people, which will be led by a person called the CEO, the Chief Executive Officer. So Chief Executive Officer considered as the key person in handling the business, in managing the business. And the CEO will be assisted by some of the key person in specific division. For example, in the marketing section, probably you have somebody to be the head or to be the president, okay, who is solely in charge of the marketing section of the company. So this marketing section are the ones who are going to do, a lot of advertisement, and they have to make sure that the company is well known to others. So that is on the marketing side. In terms of the production and operation side, will be monitored by another key person as well. Probably could be a vice president or could be a president who is in charge of the production and operation. And in terms of financing, all right, will be led by a person called a chief financial officer or the CFO. So the CFO have several important duties. Number one, they are going to oversight of the financial planning, dealing with financial planning of the firm in terms of, investment opportunities, what kind of business that the company should embark at the minimum cost, right? And in terms of finding the source of capital, that will be under the portfolio of CFO as well. They have to deal with the corporate strategic planning as well, and also the control of corporate cash flows. So let's say for this corporation, they want to embark or they want to expand their business in the Middle East, for example. There's a business opportunity there. So CFO have to decide whether investing money, expanding the business in the Middle East is worth investments or not. So they have to do the analysis, right? And check whether the investment would bring huge benefit to the company or not in terms of the profits, in terms of making values to the shareholders' investments, in terms of making values to the whole company's punya financial performance and so on. All right. And they have to do a lot of analysis, costing analysis, they have to do forecasting, projections, and so on. And they have to find ways how to expand the business at the minimum cost as well, and also finding the source of capital. You want to expand the business in overseas. It requires an additional $20 million. From where are you going to get that $20 million? So, CFO have to make a good decisions, right, in expanding the business. So it's all about dealing with making good decisions that can benefit the company and also the shareholders of the company. So CFO will be assisted by another specific downline department by the treasurer and the controller. So the treasurer will mainly deal in terms of managing the cash flows of the company, credit management, capital expenditures, financial planning, and so on, while controller mainly works on the taxation part, preparing the financial statements, cost accounting, and data processing. So these are the role of the finance people in a corporation. And overall, this is how a corporation looks like in the real world. And yeah, so that is all for part 2. So I hope you get some valuable knowledge from this part. So to conclude our discussion, there are 3 types of business organization. The first one is sole proprietorship, single owner firm, single owner business. Second is partnership, whereby the owners are more than one, and either you are the general partnership or limited partnership. The third one is corporation. And that's the end of part 2. I see you guys in part 3. Bye-bye.